There is a new tax break this year that can lower what a senior owes by thousands of dollars, and the people it belongs to are the least likely to ever hear about it. It was written into law recently. It has your name on it if you are 65 or older, and yet the government that created it is not going to knock on your door and walk you through how to claim it. It simply sits there in the tax code waiting. And a lot of good, careful older people are going to leave it sitting there again this year, not because they do not qualify, but because no one ever sat them down and explained it in plain words. So let me do that now. I went through the new tax law and the IRS's own filing guidance so I could tell you three things: what this break actually is, whether it applies to you, and the one quiet mistake that will cause millions of seniors who fully qualify to receive none of it, not a single dollar. That last part is the one I'm most worried about because it is the easiest one to fall into, and by the time you would notice, the year is already gone. We will get there, but first, the good news, and it is bigger than most people realize. This deduction is new, and it runs for 4 tax years in a row, from 2025 all the way through 2028. It applies to this year, the 2026 tax year, the return you will file next spring. It also applied to last year. So if you have not claimed it yet, you are not too late at all. It is sitting right in front of you for this year and for 2 more years after that. And if you already filed last year and no one applied it, do not worry. There is a way to go back and correct that, and I will come to it near the end. It is a new deduction built just for people who are 65 and older, and it is worth up to $6,000 for one person and up to $12,000 for a married couple where both of you have reached 65. Now let me be very clear about one thing, because this is exactly where people get the wrong idea. This is a deduction, not a check. No one is mailing you $6,000. What a deduction does is lower the slice of your income that the government is allowed to tax. For a lot of seniors, that can mean hundreds and sometimes more than $1,000 that stays in your pocket instead of going to the IRS. It is real money. It is simply money you keep, rather than money you receive. So, who gets it? The rule is refreshingly simple. You need to be 65 or older by the end of the tax year, and your income needs to sit under a certain line. For a single person, the full break is there when your income is under $75,000 a year. For a married couple filing together, that line is $150,000. Above those lines, it slowly shrinks, and at the very top, it disappears. But here is what I want you to actually hear. The large majority of seniors living on Social Security and a modest pension or some savings are comfortably beneath those lines. So if a small, quiet voice in your head has already decided this is probably not for you, that voice is most likely wrong. Do not talk yourself out of it before you have even checked. Now here is the part that even people who have heard about the $6,000 almost never know. This new break does not replace anything. It stacks. For years, there has been a separate extra deduction for people over 65, sitting quietly on top of the standard one that everybody gets. Most seniors never noticed it because it was applied without a word. This new senior deduction is added on top of that older one. So there are, in truth, 2 senior deductions working side by side this year, not one. And you do not have to itemize, you do not have to keep a shoebox full of receipts, and you do not have to hire a soul. Both of them are yours, even if you simply take the standard deduction, the way most people already do. Which brings me straight to the thing I told you I was most worried about. Because everything I have just described only reaches you if you do one specific thing. And there is a whole group of seniors who, through no fault of their own, are about to not do it. Here it is. To receive any of this, you have to file a federal tax return. That sounds almost too obvious to say until you remember exactly who we are talking about. There are millions of older Americans whose income is low enough that they are not required to file a return at all. And so for years, very sensibly, they simply have not. No one made them, and nothing went wrong. But that reasonable habit is now the one thing standing between them and thousands of dollars. Because a deduction you qualify for does absolutely nothing if you never file the return that claims it. If that is you, or if that is your mother, your father, or a neighbor who lives quietly on very little, please let this land. This is the year to file anyway, even though no one is forcing you, because filing has quietly become the only door to money that is already yours. And you do not have to do it alone, and you do not have to pay for it. There are free tax help programs built specifically for older people and for people with modest incomes, run by trained volunteers, including ones offered through the IRS and through AARP. They will sit down and do the whole thing with you, for nothing. I will leave the names in the description. And this is the part I promised you earlier. If you already filed your return for last year and this deduction was never applied, you are not out of luck. You are generally allowed to go back and correct a return you have already sent in, usually within about 3 years, by filing a simple amended return. So if you think you may have missed this for last year, that is not a closed door either. The same free tax help programs can walk you through fixing it. So the money you were owed does not just disappear because of a form that was filed before anyone explained this to you. One caution, because a break with a big number attached always brings them out of the woodwork. No real government program is going to telephone you to sign you up for this, or ask you for a fee to release your $6,000, or need your bank information over the phone to make it happen. That is simply not how any of this works. You claim it yourself, quietly, on your own return. Anyone who calls you promising to handle it for a fee is not there to help you. They are the very reason a break like this needs a warning label in the first place. So, step back with me and look at the shape of the whole thing. A law was passed. It put your name on real money and told the IRS to let you keep it. And then, the way it so often seems to go, not one piece of the system is built to come find you and make sure you actually get it. The deduction is real. The eligibility is yours. And all of it still waits, patiently, behind a single form that you, or someone who loves you, has to sit down and file. This money does not vanish tomorrow, but every year it goes unclaimed is a year you quietly overpaid for nothing. So here is the one thing I will ask of you. If you are over 65, promise yourself that you will file this year, and make sure both of these deductions are sitting on your return. And then picture one person in your life who lives carefully on a small income. The kind of person who stopped filing years ago because no one ever told them they should start again. Send this to them. It could be the difference between a hard year and an easier one, and it costs you nothing but a moment. This video is for general information only, and it is not tax advice. The rules and the income limits can change, and they depend on your own situation. Always confirm the details for your own return with the IRS through their official website or with a trusted tax professional or a free tax help program in your area.